Hi, I'm Steve Van Metre. It's Friday afternoon and we are live with our weekly economic update. Bull market or bull trap is our topic of the week. And there's some easy ways to figure out if you're still in a bull market. What is a bull market? It's any condition where stock prices are just rising. What's a bull trap? Well, when people that think the stock market's still rising and so they buy in only to find out the rug gets pulled out from underneath them. How do you know the difference? Well, there's a really simple way. You can take a bull market and flip it upside down. You get a bear market, and in bear market, corrections go to the upside. And that's the allure of pulling people in. But there's three key ways that we can look and determine if we are in a bull market or in a bear market. Now, we look at moving averages on our Monday and Wednesday evening lives. And of course, we look at them on Fridays, our afternoon lives. And we can look at the daily, weekly, and monthly moving averages, and all they do is tell us what has gone on. They're just an average of prices over a period of time, and so we can look at them when they're trending upward. Well, that means you're probably still in a bull market, and when they're trending downward, that means you're in a bear market. The other place we can look is with the banks. The banks, they know a lot, and they would be considered the smart money. Are they the entire group of smart money? No, but they know a lot. We'll talk about them too, and of course, you can't have any discussion of bull market or bull traps without talking about, well, the Fed. Kimberly Marine, thanks for joining us. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. The opinions expressed in this video that I'm on do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial. All right, so let's talk about the banks. And why are the banks, why would you consider them the smart money? Well, what do the banks know about you? Well, they know how much money is in your checking account, your savings account. They know how much you get paid because you deposit your paycheck in there. They know what you charge on your credit cards. They know your income from, in fact, if you go buy a home or a car or some other large object, they've got all of your income and asset verification because we give it to them. They know when you miss payments. They know when you're late on payments. They know everything. And so you have to look at what the banks are doing. You can't listen to what they're saying. You have to watch their feet. And the reason you do that, because over the last couple of weeks, the CEOs of major banks are saying, hey, everything's good, buy stocks, it's great, go, go, go. But what are they doing? Well, we can take a look at that as we do every week. And the best place to look is on the Federal Reserve website. And so let's start here, and we'll get to our charts shortly, but this is the assets and liabilities of commercial banks. This is the H.8 release, and you can just go to the Federal Reserve website or just do an internet search for Federal Reserve H.8 and you'll get this. Now we normally don't look at this screen, but I thought it was interesting. This is the year over year rate of change. And if you don't know what year over year is, it's simply what are we doing now versus what we did a year ago. And that's all it means. So it gives you a good idea of a trend. And in the trend, we can look here at Treasury agencies and securities. My mouse has been acting a little weird. And we can see that there is a 31.8% year over year increase in the amount of Treasury and agent securities banks are buying. So they're buying bonds at a 30% higher rate than they were a year ago. And that is very interesting. As I look down here, something that stood out to me is total liabilities. And we can go back years and years ago, but you'll notice that total liabilities are fairly flat starting, somewhere around 2016. I mean, 3.5% increase isn't much, minus 300. And now all of a sudden, look at this. Their liabilities over a year ago jumped to 9.4%. The last time liabilities started to get a little out of line, we had a soft recession in 2016. So that's very interesting, but let's go look at the hard numbers. And I added these up earlier and I already forgot them. So that's we'll do it together. Here we got Treasury and agency securities, the second week now of January. So the week ending January 2016 versus January 9. And we can see the banks added $22 billion of Treasury and agency securities. That is a substantial number. We already knew on a year-over-year basis of increasing. And December was the largest month in the history of commercial banks buying Treasury bonds. Phenomenal. Looking at mortgage-backed securities, And you can see this was a huge increase. We've got 34 billion increase over last week. I mean, wow, they bought a ton of mortgage bonds. And then non-mortgage backed securities, those slid a little bit. These aren't as critical. You see they don't own, nearly as much. I mean, 800 billion compared to, 2.7 trillion and almost 2 trillion of mortgage bonds. These decreased, 12 billion. But those are substantial increases in Treasury bonds. So what does that tell us? Well, it tells us the banks see something coming. Now, why do banks buy or sell bonds? Well, they primarily buy, or let's talk about why they sell them. So let's say a bank has a pool of bonds and they're seeing a bunch of lending demand coming in. Well, where do they get the money to loan? Well, they have, cash on hand and they have money coming in. They can lend that out, but what if the demand exceeds that? Well, they sell bonds, Treasury bonds, because they're the most liquid instrument in the world. There's always a buyer, always a seller. There are people out there that will buy Treasury bonds, no questions asked. They're literally the most liquid financial instrument in the world. You thought your dollar bills were? Nope, it's Treasury bonds. And so what banks will do is they'll sell those bonds to raise cash to lend out, and they do that over and over. So what happens when banks are buying bonds? Well, it tells us the opposite's happening. They think lending is going to contract. They also believe that they could be a recession or a soft recession or economic contraction of some sort where they need to buffer and build up what's called their loan loss reserves, which in their quarterly earnings reports that have been coming out last couple of weeks, well, what have banks been doing? They've been increasing their loan loss reserves and buying bonds. So it tells you the banks see something coming that the stock market isn't actually showing us. So that's a very leading indicator that the smart money, our first checkbox is, what are the banks doing? Well, they're buying massive amounts of bonds. Well, let's go back over to our PowerPoint and jump through the slides there and see what we can figure out. And I'm going to double check and make sure I'm on the slides. I've been having issues with this, but so we're on there now. So we'll look at the M2 money supply. And we now know that this big jump here a couple weeks ago was due to people selling their stocks and putting money in cash. Now, this by itself it's not really an indication of a big jump in economic growth, because people that put money back into cash, say from their IRAs or 401ks, they're not pulling that money out and spending the real economy. They just parked it there. So this is kind of a little anomaly in the data that makes things look a little better than they are. But we now know that we could see this week it is nose down a little bit. Over the next couple weeks, because this is always 2 weeks old, we should start to see the government shutdown come into effect where people aren't having paychecks. So we saw the M2 growth decrease by 1 billion this last week to 679 billion. The 6 and 3 month rate of change were rising, but the rate of increase is slowing. So I suspect that will turn around because a lot of money got pulled out during the shutdown, just simply because money just didn't enter the economy and it had to go to pay loans. So we should see that decrease. Commercial industrial lending on a year-over-year basis held flat at 10.6%, but it's 10.6% growth by itself. If I just put that number up there, you say, wow, that's a lot of lending. Well, it's a 10% growth rate over 1.26 the year before. Not that impressive. It just looks really good on chart, but it's not impressive because it's coming from right here. And this is looking like it's finally starting to roll over, and I believe there's a strong relationship between the US dollar and commercial industrial lending. The dollar starting to roll over as well. Now, just so you know, this chart and this chart are not updated. This is one of those weird things where I was downloading the charts today because they come out and they downloaded just fine and they were white. I mean, there's nothing. I mean, it was just like white. So I tried it again and I got the same results. So I'm guessing the Federal Reserve database system is on shutdown at the moment. So we'll anyways. So the credit card and revolving plans, they're down 4.61%. And remember, I keep saying it, and as this goes down, and it's down somewhere in here, so goes the economy. And this would be a red flag for the banks that are seeing credit growth slowing. Switching over to the Federal Reserve balance sheet. Again, now let's talk about what the Fed's up to. So there's a lot of hoopla today about the Fed's meeting next week and they're going to pause the balance sheet unwind. No, they're not. The news is just making stuff up because somebody read some meeting minutes and said, oh, the Fed's going to talk about their balance sheet unwind. They do it every month they meet. Every meeting they discuss the balance sheet unwind. Why? Because I read the minutes. It's always there. So, I mean, it's one of their biggest programs. So, yeah, of course they're going to review it. Now, Fed Chairman Powell said that in this upcoming January meeting, they were going to do more in-depth look at it. Now, they never said we're going to stop it. They did say if the conditions warranted, yeah, we'll cut this thing off. But the conditions warrant it? No. In fact, they don't warrant it at all. All they're trying to do is figure out where they're going to stop it. And he has been very clear is it's going to stop when it's substantially lower, but higher than it was when we started it. And he said the Federal Reserve balance sheet needs to be big enough to support the currency in circulation. So my guess is, and from a few people that seem to know what's going on, our guess is that it's going to be around $2 trillion and the Federal Reserve balance sheet is around $4 trillion. So as we look at what the Fed is doing, the question is, did they pause or stop after a 20% market decline? We should see it in the data. Now we know the People's Bank of China has been dumping liquidity into their economy to keep it alive. The European Central Bank, which is supposed to have stopped, is cheating, and they're doing it. But what are we doing? Well, we're not doing anything. We're continuing to unwind the balance sheet, and we can look and see here we are in January of 2019. Here's looking in December, and you'll notice even as the stock market declined 20%, which is not shown here, the Federal Reserve did not stop their balance sheet unwind at all. And here, by sometime this time next month, we should be under $4 trillion with some more downside to go. So there's no indication the Fed is stopping. So when you look at the question, bull market or bull trap, well, bull markets are born on Fed easing and they continue based on Fed easing. So here we are over 3 years, one of the longest tightening cycles in history of the Fed, and they're still tightening. So far, no bull market, bull trap. All right, going on. Now, this is interesting, and I don't have a system that will show us this, unfortunately, but I believe if we look at the Federal Reserve balance sheet and we look at, forward earnings per share. So this is forward guidance of what companies believe they're going to earn per share, and forward earnings per share is showing that the S&P 500 should be fair market value around 2,100 and is currently around 26 something. This is a few days old, and I believe, and I cannot chart it directly, is this is telling us where things are going. The other thing that tells us where they're going is the money supply. And why does that even remotely make sense? Well, if there's less money in the system, how can companies earn more? They can't. It's mathematically impossible. So what this is telling us is the S&P 500 should have a date much lower. And I've said this is somewhere between 1,800 and 2,100 is where it ought to be. And forward earnings per share projections are telling us that. Bank deposit growth jumped up to 2.79%. We don't see it here because this is one of those charts that was not working along with the other ones. And so deposit growth is still very low as the economy is slowing down. So the banks are obviously worried. They want to see depositors raising cash. Now, why would you want to see that? Well, if you thought the economy was going to slow down or recess and you're a bank and you're holding all these loans, what do you want your customers to have? Money to pay them. They're loans, right? And they're not. So this is a big indicator that the consumers are not in a healthy position at all. This is, I think, our last slide is the equity put call ratio setting up for a move lower in stocks. This one showed up on Twitter today, and you can see when the put call ratio is at a high, this is when people are betting. They're using option contracts to make a pure bet on whether the stock market's going to go higher or lower. And so this is a bet the market's going to go higher, higher, and higher up here. This is lower down here. And you can see when it gets up to these points, you get a drop. And why does that happen? Because the big players love it when market participants overcommit to one side over the other. They think it's like taking candy from a baby. So that's what we've got on the charts. So that is signaling to me that the market is indeed more likely in a bull trap than a bull market. Now let's go and, I wanted to look at momentum. Let me get my charts up before I forget about it. So you're going to briefly see, okay, I want to make sure you can see this. because again, I've had some problems yakking along only to find out that you are looking at me reading my charts. So here we've got these are my proprietary momentum charts looking at the 12-month rate of change, annual momentum against the closing price. And I've smoothed this out a little bit to make it a little easier to read. And what we're seeing is this is the broad energy sector. Momentum is declining as prices are rising. And anytime, here's a good example. So momentum right here was headed negative. Prices were rising. And then all of a sudden, rug gets pulled out. And so that's kind of what you see in momentum. Looking at financials, they are negative. This would suggest that you would want to short financials or buy bonds. Oh, buy bonds? You mean what the banks are doing? Oh. Interesting. So anyway, so this is telling us that this move up here is not valid because, again, you see it was crossing down here and prices had to fall. That's probably not the best example. Here we see it crossing as the market, it's right in here trying to make a rise, and all of a sudden the rug gets pulled out from underneath it. Let's see what else we've got. The S&P 500 using the ETF symbol SPY as our proxy. Here we can again see momentum is negative, and every time it's negative, there's usually a big drop, and you can see that coming. So the S&P 500 price is rising, momentum's negative, and that tells us this price move is not validated because you want to see prices rising as momentum is bottoming or increase, and it's not. It's losing about 0.25% a day. The Dow is validating that for sure. Momentum has also negative against a rising price. That will not hold. The Nasdaq is the only one that's not turned negative yet, but its day is not far off. It's losing value or its rate of change every day. Looking at the gold miners, we see annual momentum rising, and this is a positive move. And what's interesting about when you see momentum rising and price starting to rise, I always tend to see that there's usually one final pullback in price, and then momentums continue to rise, and then price takes off. And we'll look at that in charts, as we do pretty much every week. Oil and gas producers, remember I said there's a double bottom coming, and on this chart, a little easier because you can see double bottom, and not a double bottom, but look at what momentum's telling us. Momentum's telling us, no, you've got another move down to come. So that is yet to come. And again, just more evidence that we are indeed in a bull trap and not a bull market. All right, on to the charts. Let's take a look at the moving averages. So we've got the 50-week, which is always in green, the 50-day, always in green, 100-day, always in blue, 200-day, always in tan, and these are just the average of the prior number of days. So we can look right now and see the stock market. I don't know if you can see this light brown line moving, but it's found support or resistance right up here. And so right now the markets are still right where they were mid-December of last year. Still, anyone that bought last year is pretty much in a lost position unless they bought right down underneath here. But look at the moving average. They are turning downward, except the 200-day it's flat, but it's going to turn down as, of course, the 50 and the 100-day. Well, let's look at the weekly moving averages and see what's going on there. And I'll zoom in a little bit. Well, we see that they're starting to plateau. The 50 week has already started to make a turn down. The 100 week is starting to peak, and the 200 week is slower, so it's not quite there yet. And if we zoom out a little bit, we can see that by the time the 200 week rolls down, you're already too late. The 100 week, it's a little late. It gets there, but when this 50 week starts to roll, you're going to see another move down in the market. Now, does that mean it can't come out of that? It doesn't mean it can't. It just means it's highly unlikely given what we see out of the banks and the Fed. So there's your look at the moving averages and what they're telling us. Now, while we're on, let's zoom in a little bit. While we're on this, should this break down, and I believe it will, the next likely destination should be around somewhere between 2100 and 1800 are the next major zones of support, providing it doesn't hold up at this bottom here. And I don't think it will. Again, the banks are suggesting it won't. So that's the direction we see the market heading. Let's take a look at the Nasdaq. Same scenario on the Nasdaq. We'll go to the 2-year chart. It's finding a little resistance in here, and then it's got nothing but down after that to go, courtesy of, again, the Fed. And here we see, again, the Dow. It's kind of peaking right in the same December 18 level where the S&P is. So everything's matching it up pretty nicely, except for the Russell 2000, which is still down here around its November levels. It is sitting right above this resistance zone, and I have a hunch it's going to get rejected. You can see the moving average are squarely trended down. Of course, again, the Fed's tightening, pulling liquidity out. All those things matter. Now, one thing I wanted to try, and I wanted to do it live because if it doesn't work, it's sometimes amusing to me that I try to be cool and do stuff live and then it doesn't work. So let's overlay bond 10-year Treasury yields here, and let's zoom in a little bit. And because one thing I've been looking at is the non-confirmation in Treasury yields. So here I'll mouse over so you can see this purple line. This is 10-year Treasury in yields. And so as stock prices rise, you should see Treasury yields rising with it. And well, they're not. And we know they're not because the banks are buying them pretty heavily in here. And so this tells us that this move in stocks is not confirmed by the bond market at all. And so to me, that's just another interesting side point to what is going on here. Let's take a look at the 10-year Treasury yields, which have come up and butted up against this support level or resistance level here and got rejected and have immediately started to move lower. And they should have a destination with, say, 2.6 where they'll break through and head much, much lower. Obviously, with the banks behind them, it makes a lot of sense. Looking at the 30-year, the long bond, it tagged its overhead resistance 3 times, and then it got rejected. It, too, is going to head lower. And let's take a look at physical gold. This is kind of interesting. I think that for no reason that I can find today, it jumped straight into this resistance level. I suspect it'll get rejected because it's got to come back down and probably confirm one of these moving averages, most likely the 100-day, who's moving right into this zone of support. So I suspect it'll get rejected, come back here and confirm it. Now, why do I think that's going to happen? Where was it I was looking at earlier that showed a good example of that? Oh, the bond market. You know what? Let's look at the gold miners first real quick. So gold miners, they jump too. They kind of follow gold up. They get rejected as well. At least I suspect they will get rejected, and they will too come down and confirm their 100-day because they tend to track their 100-day pretty well. But let me show you the 7 to 10-year Treasury bond ETF. Here's the 50-day moving average. So it crossed the 50-day, and now it's looking to confirm it. And where is it about to confirm it? Right in this resistance zone. Now this is still resistance because it hasn't broken through, but it's turning into support right down here at the bottom end of this zone. So this is a resistance zone, but it's finding support at the bottom end of it, and we're quickly seeing the 50-day move up. So when the 50-day connects with that, well, where does it go from there? Well, last time you saw that, we saw it cross here, bounce, and then go, and then cross here, confirm, and go. Cross here, confirm, and go. Cross here, confirm, and there you go. So we know why the banks are buying bonds, because they know the economy is slowing down, and they see nothing but upside. The same thing we can see on the long bond. This is a 20-plus Treasury ETF. It crossed its 50-day, and now it's about to confirm it as well and also take off from there. So that's pretty interesting to me. Let's look at oil and gas producers. Here we go, symbol XOP. The 50-day has been a source of resistance here, and you can see it crossed over, got rejected 3 days in a row, 1, 2, 3. It's come back, tried to cross the 50-day, got rejected. It's sitting right over the support zone, but there's likely a double bottom or something lower sitting down here, because when you see interest rates go down, so does oil. They usually kind of follow each other down. So let's take one last look at the ags. And this is kind of nice to see that we see this dotted line here, this dotted purple line is a very strong level of support. Buyers exist underneath here. And what do we see? Buyers come in and drive prices right back up today. So we're in this very tight battle, which is narrowing. And when you get this narrowing battle lines of people who are selling and people who are buying, what eventually happens is the sellers lose, because eventually you've either sold everything you could sell, which happens, right? You have no more inventory left to sell, or you short sold and borrowed everything you can borrow and sold it before you realize you just can't do it anymore. And you've got buyers sitting there just continuing to buy, continuing to buy, continuing to buy. and eventually they break through, and then you start getting an unwind of all these short sellers going out. So I think we've got that to come. What else? Was there anything else I wanted to look at? I think that pretty much covers our update for today. So let's bring the camera back on. So anyways, back to our original thesis, bull trap, bull market. Yeah, it looks like it's a bull trap. And at some point, we will start to see where the big money is positioned. And we can't see the big money because their reporting is done through the government, whose agency was on furlough. So next Friday, the data should come out. I won't probably see it till Saturday. I'm sure people will be talking about it Friday as it comes out, but a lot of people will put their charts and data out by Saturday. So it'll be interesting to see where the big money is positioned. And my best guess is they've been selling into this rally. Well, because usually you see rallies on strong volume and rising volume, and we've seen this rally. In fact, I'll show you real quick. The rally on this has been on the opposite trend. Where's my thing? Here we go. And you can see trading volume is falling and then flatlining as price is rising, flatlining and starting to roll over. So I don't see any indication that the big money's participating. So with that, I'm Steve Van Metre. Oh, by the way, if you missed the tax class, send me an email. The video is pulled off the web, but I've got a private link for you. So if you need it, let me know. Just send me an email. I'll be happy to send it to you. So until Monday night, if you have any questions, give me a call. Send me an email. I'm here for you. Bye now.